Hey, Ed Socia here, datacenterHawk, coming to you from One Vanderbilt in Manhattan. I have the honor and the privilege today of sitting with my good friend and colleague, Mike Elias of TD Cowen. Mike, thanks for having me.
Pleasure.
So, Mike, why don't you give everybody the background of how you got to be in this role and where you're from, and give us the scoop.
Yeah, so I'm a New Yorker born and raised. Please don't hold that against me. I attended Columbia University, studied engineering. I initially wanted to be a physicist, but I kind of had a change of heart as I was halfway through my curriculum. Realized that I loved interacting with people, and I thought going to Wall Street would be a good expression of interacting with clients and also using the same foundational mathematical skills that I'd built up in my academic curriculum. So from there, pivoted. When I graduated, I took a job at a long-short equity fund right out of college. I worked there for about 2 years as a generalist, and I realized that I was on a Macy's earnings call, and then I was on a biotech earnings call, and I realized I'm a bit all over the place. It's better to get expertise in one particular thing than kind of be stretched across multiple sectors. So that was the catalyst to lead me to equity research. And when I came over, I was fortunate. When I applied to work at Cowen, they looked at my background, they saw engineering, and they're like, "You're going to go to telecom."
Yeah.
And they placed me within communications infrastructure, and it couldn't have been a better fit. Absolutely love data centers. As soon as I entered the first one, I became deeply passionate about it. And as part of that, I was very fortunate to have a mentor who I believe you've met, Colby Sinosel,
of course,
who I worked for 5 years, learning everything about the data center industry. I could not have asked for a better mentor coming up in the space than Colby. He got ready to go to industry, and he called me into his office one day, and he's like, How'd you like to do this for a living? And I said, this would be wonderful.
Yeah.
And I took over as senior analyst covering data centers in March of 2022. So about 2.5 years into this journey. And it's beautiful. The more that I dig into the data centers and the more I follow my intellectual curiosity, the more I realize I don't know, which leads me to then dig further. And it's an iterative loop. And, I'm fortunate to be in a seat where every day I get to dig further and further into this sector, and it's truly been rewarding.
That's great, Mike. I first and foremost, I love Colby. Colby's from Rochester, New York. I'm from Syracuse, New York. So we've discussed garbage plates and all of the upstate central New York cuisine, and he has a great palate. So Colby, if you're watching this, cheers to you. But Mike, you talk about things like the more you learn, the more you realize you don't know, and I think that's pretty common in our space because it's moving so quickly, and we're watching this evolution and this shift in, requirement sizes and deployment strategies, and everyone's talking about the buzzwords of AI. But are we in the machine learning phase? Are we moving towards inference? And I think we both agree we're more in the ML on the ML side of things now. But let me get your take on how have you seen, I guess, the demand for digital infrastructure real estate? How has that shifted in your mind in the last, let's say, 2 to 3 years?
Sure. I'd actually, I know you said 2 to 3 years, but I kind of want to take it back a little bit further.
Please.
I look back to really 3Q 2015, 4Q 2015 as really the beginning of the uptick in larger, and it's funny, when I say larger requirements, I'm talking about 5 to 10 megawatt requirements, right? We saw that uptick, and that to me really characterized the beginning of the cloud era for third-party data centers. Mm-hmm. Some may disagree and say it started a bit earlier, but that to me was the turning point. I'd say the market was generally categorized by periods of boom and slight boom and then slight bust. Principally, if you look back 2017, we saw one hyperscaler come to market in a meaningful way, drove very high leasing volumes for the third-party data centers, at least by those standards at that time. And then you were followed by a digestion period. Then we entered COVID. And that's where I think the paradigm started to shift, right? So this is your question, kind of like last 2 to 3 years. So let's talk about post-COVID. In the COVID era, you saw the digitization of everything, which required really incremental data center capacity to support it. You saw a bit of a pullback on the part of the enterprise, but nonetheless, the hyperscalers really continued to drive the market. Since 2020, my observation is it's pretty much been up and to the right every single year, driven by the hyperscalers with some vacillation on the part of enterprises in terms of their demand. Where things really changed, I would say, in the market from that steady growth of incremental cloud capacity was in the second quarter of last year, where we flagged in one of our notes that we'd seen the tsunami of data center demand hit the third-party data center market. And that's where really the universe changed. One hyperscaler went from, at the beginning of 2023, discussing with third-party operators that they were essentially going to, they're full for the moment, they're going to take a step back from the market, to 2 months later calling around and asking, what do you have and how fast can I take it, right? So we saw the paradigm shift. I think we're continuing to see that strength in demand. I think the narrative from a financial perspective has started to change, where you're starting to see the introduction of this question of, well, we're spending all of this money in incremental data centers. What is the return? That's been certainly, as I've been on the road meeting with investors, that's something that has been kind of top of mind. But I remind investors, I say, if you were to judge the internet on its first year, right, or the first year investment and the returns that it generated, well, it'd be wildly disappointing relative to the internet as we know it now. So I say, the investments are being made. There needs to be some time for us to get the data centers online, ultimately do the training, which leads us to the inference, which is really where you're going to see the monetization engine on the part of the hyperscalers and those who are investing in training really start to bear fruit.
Mike, and I want to take it back a little bit to what you were saying. When you talk about COVID, I think the really interesting thing there is the bifurcation from the hyperscalers between the self-built, self-operated stuff and the deploying with third-party data centers, and this hybridization of the workforce. The example I always gave was in March of 2020. I think Zoom was averaging like 30 million calls a day. By the end of March of 2020, it was up to about 300 million, and then by April, it was over 400 million. And that's just continued. The hybrid workforce while there has been a return to the office, it's still a dispersed workforce. And that's certainly led to that sort of uptick. But then, as we talk about now, that AI push and just the open AIs and these guys trying to get ahead of it has really shaped, I think, a lot of the deployments we're seeing now and the pre-leasing that we're seeing today.
Correct.
So one thing I would ask you, Mike, how do you think that geographic location and the ever-changing, ever-evolving infrastructure, so let's go back to when you were saying, 10 to 20 megawatt data centers. Now we're talking about 2, 3, 500 megawatts, multi-gigawatt campuses coming online. How do you think that evolving infrastructure has affected the capital side?
So what I'd say to you is, for actually two things. First, I want to take the geographic side, and then we'll talk about the capital side.
Yeah.
So simplistically, as I think through data centers, I like to break it up into 3 chapters. The first chapter, data center 1.0, I call the internet. It's the internet era, right? Take it from 1990 back to your ARPANET all the way through 2005 before you saw the introduction of the cloud by Amazon. Then you have the cloud era. Let's call it from 2006 through 2022. And then you have what I call 3.0, right, which is AI and beyond. If we consider the first 2 chapters of data center history, the internet, very much about low latency and being close to the end user. Then you go to 2.0 and it's the cloud, but instead of wanting to get the eyeballs in the household, now we're talking about you want to be proximate to the enterprises, which again requires some form of low latency. So with that, one of the things I find very interesting is that we've had a propensity, given the need to reduce latency, to cluster data centers within large major metros. But then within that metro, we tend to cluster the data centers all around, certain data centers. Like think of Northern Virginia, the rings built around, certain interconnection facilities, right? Now, as we go into 3.0, especially in the machine learning phase, latency is less of a consideration. So we're seeing an opening of the aperture in terms of where these data centers could be located. Now we'll switch over and talk about the capital side and then double back into geography. So from a capital perspective, look, we all know cost to build, depending on what market you're talking about. If you're building for the hyperscalers, I would say low end these days is probably $10 million per megawatt.
Yeah.
At the high end could be 12, 13 when you're talking about all-in costs, and that's in the United States. I've been having conversations that suggest in Europe, it could be even higher. That's your starting place.
Yeah.
As you increase the size of the data center, you're not really getting incremental. You're not getting that number really lower and lower and lower. So you tell me a gigawatt at $10 million per megawatt, we're talking about $10 billion to build out that data center, right? Now, if we think about the way that traditionally these data centers have been financed, there's been, a heavy reliance on debt. I'd say, depending on the operator, we're talking 50 to 70% LTV. But at a gigawatt scale, 50 to 70% LTV, we're talking about you're writing an equity check from between $3 and $5 billion.
That's right.
Right? So it's a certain type of capital provider who can really play in this space. And that's different from, if you take it back to 2015, it was private equity firms in the space. Then you saw the gradual introduction of real estate capital into the market. Now you see infrastructure, you've seen infrastructure capital come in. So really the market, I think, is shifting itself in terms of the capital providers to, long-term capital that has depth to it. Because that's what you need to be able to play in the space. I was having a conversation with a good buddy, and he's saying to me that, back in 2013, $10 million would move the needle. Now $10 million doesn't get you a seat at the table.
Yeah, that's right.
Right?
That's absolutely right.
So that's the evolution we've seen. And I think the market is looking for deeper and deeper capital pools to tap in order to support the growth. Now, I would say beyond that, now bringing it back to the geographical the geographical dynamic, because machine learning is less location sensitive, you're seeing increasingly the move, coupled with power constraints, the move for these data centers to be further and further away from the major metros and further flung areas where power is accessible. I think right now what the market is working through is the capital knows what the value of a 100 megawatt data center in Ashburn is. It knows that, right?
Yeah.
It can underwrite that. I think the market is getting its hands around, as we talk about data centers in more remote locations, what's the long-term value of that? I think that's a dynamic that the market's that's going to work through over the course of the next year as we plot the path forward for building out these large footprint machine learning data centers.
Do you think that the, pool of companies with deep enough pockets to be able to, as you say, have a seat at the table, do you find that pool is shrinking? I mean, when we're talking about $10 billion for a 100 megawatt data center, and I think that's even on the low end.
Yeah.
The amount of capital out there that's accessible to these companies, it's when that number continues to grow, it just seems as though, again, the players who are able to get a seat at that table are limited.
I would say this to you. And if I use, candidly, my inbox as any barometer of this,
sure.
I think it's actually increasing, not decreasing.
Okay.
All right. And I think it's a function of two things. One is that we have seen, following years of price declines in the data center space, we've seen an accretion in pricing and we've seen an accretion in returns. Second is that, and I think, this may be a odd benefit for the data center space, but data centers are in the press.
Yeah, of course.
This went from a niche industry where, as you and I, we go to these conferences and we all knew each other.
That's right.
Now we're seeing new faces emerge on the capital side, on the operator side, right? So I think there's incremental capital interested in deploying in this space. And I can think of at least two large asset managers that are very large asset managers that are actively looking, to get into this space. So I think that has been a tailwind to capital coming into the space. Not only one, pricing and returns increasing, but then also more general press around data centers. And you have people like Sam Altman out there talking about the need to build incremental data center capacity, how to deliver on the benefits of AI, we need gigawatts and gigawatts of incremental data centers. I think that sets itself up really well to attract incremental capital. And I've been pleasantly surprised to see that capital has not been the primary constraint to the growth of the data center industry. We've seen that constraint manifest in other areas.
On the other side of that coin, do you think there's any risk to, I don't know if overcapitalization is the way to phrase it, but capital coming in from institutions that, are unfamiliar with the world of digital infrastructure or the digital infrastructure landscape. Do you think that these folks who are coming in that, maybe they had more traditional real estate assets in their portfolio, and now they're saying, hey, we can get great returns on data centers. Do you think there's any risk there?
I think marginally. I think there's some marginal risk there. But I think there are a sufficient number of hurdles to them entering the market and then causing issues. Because for me, as I think through the big risks to the data center space, and really think about through any capital cycle or any period of expansion and typically contraction, in a period of strong demand, you see overbuilding in the real estate sector. Take it back to what we saw in 2008, in the residential market. Even take it back to 2000s and what you saw in data center land, right? You saw a big boom in data center construction on a speculative basis.
That's right.
Which then all of a sudden, when the dot-com bubble kind of popped, you then saw a lot of bankruptcies on the back end. What I'm encouraged about right now is while there is that capital looking to get into the space, while we are starting to see, and I've written about this in my reports, we're starting to see, I think, more of that capital go into the powered land side, essentially speculating around, hey, I got this land, I got this power, maybe I could sell it to a hyperscaler, I could sell it to a third-party data center operator. In terms of ground-up construction being done speculatively and in perhaps an uneducated manner because it's new capital coming into the space, we're not really seeing too much of that, which to me is encouraging. Where I would start to get concerned is if we saw the amounts of capacity under construction that's pre-leased start to decrease. That's when I would start to say, okay, pool of capacity is increasing, less of it is being immediately off-taken. What's going on with the supply-demand balance here? But as we're at 80, depending on what stats you look at it, we're at 80% pre-lease rates. I think the market is sufficiently tight from a supply-demand imbalance that I don't see new capital entrants ruining the party, if you will.
That's a great take, Mike. And I think it's when we talk about supply and demand, and you bring back 2008, but let's even think about 2018. There was a ton of speculative development happening then. And it translates to the asking rates, right? Which is passed through to the tenants.
Yes.
So we've seen, Northern Virginia, let's say in 2018, 2019, you saw some what then were substantial deals. Let's call it $70 a kW.
Yeah.
Those same deals today are getting done at 140, 145, and I think that's because of the limited optionality. Let's say the blended average vacancy rate across the board is probably around 3%, I'd imagine. But when you get into those tier one primary markets, most of the markets are sub 1% vacancy. I think Northern Virginia right now is about 0.6. And, that has lent itself to the pre-leasing it's not only that pre-leasing continues to happen, the amount of time between a developer acquiring the land with a clear path to power, or whether or not it's a will serve, or they say, hey, we might have to wait a little while, but that power is there. We can grow. I think that lead time is shorter than ever before, where maybe before, they would buy the land, they'd have the will serve, they start moving dirt around, they start building the data center, and then it's pre-leased. Now we're hearing folks say, hey, we just bought land in, South Dallas. We just acquired this land. We've talked to Encore. We have the will serve letter. And then the hyperscalers are coming in and saying, great, we'll take everything you can give us. And, here's the dough to do it. Would you agree with that? Are you witnessing that?
Yeah, I would say, the way I think about it over the evolution of my observation of the data center market is that, if you take it back to 2018, having a concrete pad poured for the facility was like the precursor to getting any leasing done.
That's right.
You had to have gotten the entitlements, you had the power secured, you cleared the land, you leveled it, you put your concrete pad down, then you could start pre-leasing.
Yeah.
Now it's a different paradigm.
Absolutely.
And I think it's a different paradigm because of what you said at the beginning. Vacancy rates are so low, and everything the incremental that's being brought to market in these primary markets is immediately getting taken up. Now, instead of having a concrete pad poured, it's, do you have power?
That's right.
And if you have power, that is a leasable facility.
Yes.
Or even though the facility doesn't actually exist yet. So I completely agree. With that dynamic. And I think that's really indicative of the degree to which the data center demand is currently outstripping supply. But let's not forget why this is happening. Yes,
Sure.
demand is very strong on the demand side, very strong demand, right? For the reasons that we've talked about, incremental demand, not only from the cloud, but then at an additive basis, we're talking about machine learning. But then on the supply side, remember what I said earlier, data centers historically, given the evolution, have concentrated in major markets, and then within major markets, they've concentrated in a small area.
Mhm.
That's a lot of dense load in a very small geographical footprint. You iterate that over 20, 25 years, you're going to end up with constraints on the local grid, especially as you consider at the chip level the increasing power consumption
Absolutely.
for the next generation of data centers, which is part of the reason why we're going from 10 megawatts to hundreds of megawatts, right?
Right.
So you put the two of them together, it's not only accelerating demand, but tightening supply because of the ability to get power,
Yep.
which is not only a function of current demand, but a function of the way that we've located these data centers in the past, putting a lot of load in a very small geographic area.
Let's talk about for a minute. So over the last, let's say 5 years, we saw a lot of the publics, a lot of the REITs be taken private.
Yes.
I'm starting to hear buzz in my conversations, which you and I talk more frequently than most of my other phone calls. But do you think that tide will turn? Do you think we're going to start to see some privates take it to an IPO and start bringing it back to a public company?
Yeah, so I'll say this to you. I think you got to understand both sides of the coin here. Earlier today, I was having a conversation with an investor, and bringing them up to speed on a few chapters of data center history. And if you ask me, the reason why the then public data center operators went private is, public market investors, historically have only so much appetite for CapEx, right? CapEx is required in order to grow, but there's almost like this magical line. And if you cross over that line, you'll all of a sudden end up with a divergence between your revenue and EBITDA growth and your FFO growth. REIT investors use your FFO as essentially and apply a multiple to it to value the stock. Right. As you get more and more and more CapEx, what you end up with is the need to raise incremental equity, raise incremental debt, which then puts pressure on that bottom line, driving that divergence, which is essentially why companies in the past that had very strong leasing, which then needed to raise their CapEx, ended up with, in one case, 20% revenue growth, 20% EBITDA growth, negative 5% bottom line growth.
Sure.
And guess what? If that bottom line number goes down and you hold that multiple the same, guess what? Stocks are going down, even if you're creating long-term value. So I think in the face of this, the public market, the public companies realize, hey, if I want to grow, it seems like the private markets are much better suited for me to be able to put capital to work and create long-term value. That led to the wave of kind of take privates that we saw. However, if you were to put together a list of the largest sponsor to sponsor transactions, I think you would see, and I actually, I don't have the data in front of me, but you would see that there comes a certain point where companies just become too large to move from one sponsor to another. Yeah. Right? And keep in mind, if you think of the companies that were taken private, they were taken private at $10 billion valuations. They weren't exactly small companies. Now, with the amount of growth that we've seen in the sector and the capital that's been put into them, if you ask me, they're getting to a scale where it's highly unlikely that one sponsor or a group of sponsors would come together and buy it from the current owner, which increasingly, again, purely intellectually, leaves the public markets as the most likely off-taker for these data center vehicles, right? And as I think about it, I can think of a few companies that come to mind in that they have done a fantastic job of growing in the private market, but the sponsor can only hold on to that company for so long, and there ultimately needs to be a realization and a crystallization of the value that's been created. And the public markets increasingly look like the most likely option, again, because of the size to which these companies have grown.
Absolutely. Recently you and I and our good friend Kevin and Bowden, shout out to him.
Yes.
We're sitting in the Austin airport talking about buying our homes, and we're talking about interest rates, and the Fed has recently dropped interest rates.
Yes.
And you were commenting that, hey, hang on, they're going to drop several more basis points predictably in the next year or so. What does that cost? What does that shift in cost of capital mean for the industry?
It's a good question, and I've been kicking this idea around. If I look at a long-term chart of data center pricing, from 2015 to 2021, you saw pretty much data center pricing decline. There were multiple reasons behind that. But what I thought was interesting is you saw from 2019 to 2021 kind of an increased step down in data center pricing. And initially you say, why is that? Well, interest rates went to zero. I know that not all deals are priced on this basis, but let's remember when it comes to data center pricing tends to be an output. You know what your cost to build is, right? You know what your long-term cost of debt is, on the back end when you stabilize this facility. If that cost of debt goes down by 50 basis points, you can accept slightly lower development yield while still achieving the same excess return spread. So as a result, if the cost to build stays the same, you can actually price data center capacity lower or more cheaply and still get the same economic returns. So when I think through the lowering of interest rates, it's good in one sense that, let's say it frees up incremental capital for the space, but also I think that, let's not forget, unless the cost of build is going up, that lower cost of capital could, in my view, translate into a slight headwind for data center pricing, right? Again, if you're pricing at now a 9.5% yield versus a 10% yield on $10 million per megawatt, just the math suggests that the data center pricing would be lower. So that's one of the things I keep an eye on in terms of, okay, if we're going to lower, again, I'm no macroeconomist. The firm has amazing macroeconomists, but to the extent that the interest rates continue to go lower, I think that's one thing we just need to be cognizant of. But on the flip side, I do think it does open up incremental capital for the sector, which I'd view as a long-term positive.
Absolutely. Mike, you have one of the most brilliant financial analytical brains ever, and you've edified me over the last several years, and I'm very grateful for that. Let me ask, my last question would be, what are you excited about over the next 5 years? I mean, what are you, what are you watching? What are you kind of rubbing your hands together thinking, man, the outlook looks good. Where are we moving, and what gets you stoked? So
I'll share this with you. This was in April. Let's take it back to 2023. This will all make sense. In 2023, at the beginning of the year, I was at PTC.
Yeah.
Right? Amazing conference.
I'll see you there this year.
Yes. Wonderful. Good. I'm happy to hear that. So PTC, folks started talking to me about ChatGPT. And, admittedly, I was like, what is this thing? They're talking about it can write code.
It does your homework for you.
Is this the latest generation of okay, it's here now and then, it'll be gone tomorrow, it's technology. What is this?
Sure.
Flash forward, I started hearing more about ChatGPT. I was like, okay, let me play around with it. And I remember the first question I ever asked ChatGPT was I asked it to tell me the history of X data center company, right? I just wanted to see what it did. When I hit enter and it returned a response, I was dumbfounded with what it. I was like, this is incredible.
Yeah.
The next thing I did is I called my very good friend and colleague Greg Williams, and I said to him, I was like, is this going to disintermediate us, in terms of a career in the future? Now, I've since thought about it, and it's like, okay, maybe not immediately. But when I think of the potential for AI and what it can do, I'm very excited. I'm very excited about that. I think it's going to be additive. I think of the applications in the medical field. I think of the applications, in terms of the ability to optimize from an organizational level. I even think of the personal benefits in terms of, the things that it could do for me in terms of being more organized, being more focused, right? Getting my work streams down and making sure that I'm focused on the most important things. That's what I'm most excited for. And as I translate that into a data center, the data center landscape, I think ultimately society will realize the benefits of AI. And once they do, I think it's going to be, it's going to be like the internet, where they want more, and there's more and more that we can do with it. And as a result, there's going to be greater and greater investment made into the data center sector. That's what gets me really excited, is the kind of next chapter. You heard me talk about data center 3.0.
Of course, yeah.
We're right at the beginning of this new chapter. I'm excited to see where this takes us. But as I think through it, it's like, if we continue to make the investments and we continue to put in the work to bring these new applications to the forefront, I think ultimately it's going to be, maybe it's a bit naive, but I think there are going to be plenty of positive use cases for society. And as a result, that's going to benefit the data center sector, to which you and I spend a lot of our time. I think it's going to be a long-term beneficiary. And for that, I'm incredibly excited.
Absolutely. Folks, you heard it here first. Mike Elias of Cowen, TD Cowen. The future is bright for data centers. I would implore everyone out there, read Mike's reports. They're phenomenal. Again, he has one of the most brilliant financial minds in the industry. Come visit us over at DatacenterHawk. We're out in the market helping you make better decisions. And Mike, thanks again for having me here at your wonderful office. Great new digs. And until the next one, we'll see you next time.
Thank you for having me.